Hello and welcome to the Financial Future Guide. I'm your guy and I'm your guide. My name is Alex and today we're looking at 3 Canadian stocks that I think you might want to buy during the market crash. We obviously cannot predict if there will be a market crash, but there are many indicators that are pointing towards so, and also just the rally that we've seen since the March lows is slowly coming to a halt. And the last week or so has been fairly choppy in the market. So today we're looking at 3 stocks that I'm watching very closely and will be growing my position in these companies if they do indeed go on sale. Now, a couple of these stocks I have discussed in previous videos, however, I do think that you should have them on your watch list, so I thought I'd better address this real quick. Now, without further ado, let's get right into it. The first stock that we'll be looking at today is an industrial stock known as Canadian National Railway. This stock is dual listed on both US and Canadian exchanges, on the Canadian TSX under ticker symbol CNR, and the New York Stock Exchange under ticker symbol CNI. CN has a dividend yield of 1.62%, which equates to $2.30 Canadian annually. CN is Canada's largest railway in terms of both revenues and physical size of its rail network. Their railways span across Canada from the Atlantic Ocean in Nova Scotia to the Pacific Coast in British Columbia, which is about 32,831 kilometers of track. In more recent times, CN has spread into the United States, taking over the Illinois Central Railway. CN serves importers, exporters, retailers, farmers, metals and minerals, automotives, and oil products. On top of this, CN also provides trucking and supply chain services such as distribution, customs brokerage, freight forwarding, marine shipping, and even storage space. I like the rail industry because of the cost and environmental advantages versus other modes of transport. When compared to trucks, we can see that rail consumes up to 9 times less energy per ton kilometer traveled, are 4 times more fuel efficient on average, can carry more freight at the same time, cheaper for long distance, and emit 60 to 75% fewer greenhouse gas emissions. As the world continues to push towards a clean green energy, it's extremely important that companies are doing what they can to improve their carbon footprint, and therefore rail transportation is going to continue to be a key part of moving goods from A to B. As I mentioned, CN is Canada's largest railway, but they do have one competitor. You may have heard of this other company. They are Canadian Pacific Rail, known as CP Rail. The extensive railway network that CN runs is simply impossible to replicate, making it an extremely valuable asset to the company. This alone provides them with a very wide economic moat, meaning competitors will find it difficult to attack the revenues and market share of CN. Over here on the stock quote, we can see that today they closed at $142.59. That's down 9 cents on the day, or 0.06%. CN have a market cap of $101.21 billion and a PE ratio of 28.22 over the trailing 12 months. CN has an earnings per share of $5.05, and over the last year, we can see that they've traded anywhere between $92.01 and $143.71. CN currently pays a dividend of $2.30, which equates to 1.62%. Taking a look at CN's dividend growth and their dividend history, back in 2009, they were paying just over 50 cents, which was a dividend yield of 1.8%. But nowadays, they are paying $2.30, which is a 1.62% dividend yield. Over the past 11 years, there has been fairly consistent and steady growth, and that is great to see. If we have a look at their payout ratio, we can see that they're paying 44% of their earnings to their shareholders as dividends, which means there's plenty of room to continue to grow that dividend. Next up is the share price versus fair value. Now, Simply Wall Street, which is a great tool for all investors, offers an estimated fair value based on the cash flows the company is expected to generate in the future. CN's fair value is $86.14, which means they're currently 65.6% overvalued. So based on this metric, this is quite expensive. So this is exactly why it's on my list to wait for a pullback. Now, we all know that I like to look at the price to book ratio, and the book value is the asset's value on the balance sheet minus its accumulated depreciation. When looking at the price to book ratio, companies which are below 1 could be potentially viewed as undervalued, and those with a higher price to book ratio may be trading at a premium. And as expected for CN, CN, they are trading at a premium with a multiplier of 5.4. But when looking at the price to book ratio, I do like to look at the competitors. So let's pull up CP Rail, which is trading at a price to book ratio of 7.3. So as we can see, investors are paying a premium price for these companies. And between the two, based on their book value, CN is trading at a lower premium. Next up is the recent insider trading, and given that this company is trading at an all-time high, we can see there is a lot of sell-off. However, you will notice Jean-Jacques, which is my homie JJ, has purchased $4.5 million worth of CN Rail. And the reason I think this is extremely important is he is in fact the CEO of the company. Notice how this was less than 2 weeks ago when the stock was trading at its all-time highs, which is fairly good to see that the upper level management believes in the long-term output of the company, willing to put $4.5 million of his own money into the company. So taking a look at the top shareholders just for this specific one, because I did want to call out that we can see Cascade Investments and Bill and Melinda Gates Foundation. Now, Cascade Investments is an American investment and holding company which is controlled by Bill Gates and holds about half of his fortune, not including his Microsoft shares. And it's great to see that the homie Bill Gates has about $15 billion into this company, which is always a positive sign when some of the greats are investing alongside of you. Next up is part of the financial sector and is one of Canada's largest banks. Canada's banks are some of the strongest in the world. They operate in very well-regulated markets, making them a relatively safe play in the financial sector. Today, we are looking at Toronto Dominion Bank, commonly referred to as TD Bank. This stock is found on both US and Canadian exchanges under ticker symbol TD. TD is currently paying a 5.16% dividend, which equates to $2.40 Canadian. TD has over 26 million customers worldwide, and they also have 23,000 retail locations across North America. They are a one-stop shop providing all banking services, including business loans, checking accounts, savings accounts, credit cards, insurance, wealth management, personal loans, home equity lines of credit, home loans, and so much more. Fairly standard stuff for a major bank. Over here on the stock quote, we can see that TD Bank closed at $61.57, down 80 cents on the day, or 1.28%. They have a market cap of $111.571 billion, a PE ratio of 11.93 over the trailing 12 months, and earnings per share of $5.16. Over the last year, they've traded anywhere between $49.01 and $77.72. And finally, they pay a $3.16 dividend, or 5.07% dividend yield. Taking a look at their dividend growth and history, we can see that they have also steadily been increasing over the last few years, from 2009 paying $1.22 or 3.8% yield, now at a solid $2.40 or 5.16% yield. TD is also only paying 59% of their earnings out as a dividend, which means that they do have room to continue to grow this. Looking at TD's share price versus fair value, we can see that their estimated fair value is $67.32, meaning they're currently 7.4% undervalued. And having a look at the price to book ratio, we can see TD is sitting at 1.3, and comparing to some of the other major banks of RBC and Scotiabank, they're sitting in about the middle, with RBC at 1.7 and Scotiabank at 1. With the drop in recent weeks, Canadian banks are becoming quite attractive, and with the financial sector not recovering as much as many of the other sectors throughout the market, a small pullback for these banks could see them down over 30% from their February highs. I would definitely keep the Canadian banks on your watch list, and my pick will be on TD. The final stock that we're looking at today is actually a REIT, a real estate investment trust, and this is personally one of my favorite stocks available for the Canadian market. My first ever video was on them for this reason, and you may recall SmartCentres. SmartCentres can be found on the Canadian exchange under SRU.UN. They currently have a 9.25% dividend, which equates to $1.85 Canadian annually. SmartCentres owns 166 properties in key locations across Canada. Many of these locations are well positioned at major intersections. Although historically SmartCentres has been retail focused, they have begun to diversify and are quietly becoming a very diversified real estate company. Over 50% of their rent comes from places like Walmart, Loblaws, Canadian Tire, McDonald's, LCBO, Rexall, and the major banks. And over 60% of their tenants are deemed essential services. This means that if we do see a market crash, that has been driven by the pandemic. Although SmartCentres will take a hit as a real estate company, many of their tenants will continue to operate and likely be able to pay their rent. SmartCentres has also been investing heavily in self-storage units, apartment living, senior living, and condos and townhouses. The strategy that SmartCentres is using to diversify is called intensification, which is being driven by their excellent leadership team. Intensification is taking their current properties, which are primarily retail focused, and building them into community hubs. This not only becomes a huge convenience for those who live there, this will also drive up retail sales, which makes SmartCentres a very attractive partner for major retailers. SmartCentres was started by my brother from another mother, Mitchell Goldhar. He is a multi-billionaire Canadian who was the one that first brought Walmart to Canada. He now is the president of the council and still owns 10.29% of the company, which equates to $354 million. This man is highly respected among his peers and has put together a great team of people to run his company. Feel free to pause the video right now and admire this man and everything that he's done in his glory. Look at that face. Look how serious this man is. He's here for business. On to the stock quote for SmartCentres, we can see today they closed at $19.79 Canadian, down 34 cents on the day, or 1.67%. They have a market cap of $3.363 billion and are trading at a PE ratio of 26.39. However, when looking at a real estate investment trust, it is more important to look at the P to FFO, which is price to funds from operation. This is because a real estate investment trust makes its money from collecting rent. Therefore, funds from operation is the most important metric when looking at their earnings. To put this price to FFO in perspective, currently the average in Canada is 15.3. Next up we have earnings per share, which is 75 cents a share, and they've traded anywhere between $14.58 and $33.10 in the last year. And finally, they pay a dividend of $1.85, which is 9.25% dividend yield. Over on the dividend growth and history, they have been growing it since about mid-2014, where it was previously $1.55 at 8.6%, but is now $1.85 at 9.25%. They are only paying out 59% of their earnings, which is somewhat low for a real estate investment trust, so there definitely is room to continue to pay it or to grow it. Now over on the share price versus fair value, they are currently at 54.5% fair valued based on the fair value estimate of $44.55 from Simply Wall Street. And then taking a look at the price to book ratio, SmartCentres trades at 0.7, which tells us that it's undervalued. And comparing it to RioCan, a top competitor, at 0.6, we can see this is fairly consistent. And then Choice Properties, another large competitor, is 1.2 price to book ratio. A lot of the retail focused real estate companies have been beaten up over the past few months, with the pandemic forcing many retailers to close. If you're like me and believe that this is temporary losses, SmartCentres may present a lot of value to you. Finally, if we take a look at the recent insider trading, we can see one man and one man only. Yes, I'm aware there's more men, but they're not relevant. Mitchell Goldhar is the man himself, and he seems to buy a couple million every week or so. This is great to see that the man who started this company, who grew this company, strongly believes in its future and sees great value at these prices. Much like my man Mitch, my buys have looked very similar, very consistent, just not quite the same values. However, as we have seen a pullback and we are likely to see further falls, I will be doubling down and picking up as much as possible. Alright, well thank you for watching today's video. This is just, as I mentioned, my watch list and what I'm looking at for the possible market crash that is looming, but I would love to hear what's on your list. Are there any stocks you've been waiting to get a position in, or maybe you're looking to grow some of your current ones substantially once we see some of these companies go on sale? And if there are any companies you would like me to have a look at, analyze, or give my feedback on, please let me know in the comments below and I will help you out as much as possible. That's all for today. Remember to like, comment, and subscribe to see videos similar to this one.